Yesterday, I did a video on deep value investors Monish Pabrai and Prem Watsa talking about very interesting commodity bets that they were making, potentially seeing a lot of deep value in various different commodity companies. Since then, you have various super investors also reporting their third quarter investment portfolio updates, including Warren Buffett's Berkshire Hathaway, Bill Ackman, Michael Burry from The Big Short fame, and Stan Druckenmiller, 30% for 30 years, not a single down year, Stanley Druckenmiller. So you're talking about these are the great investors, the greatest of all times, the GOATs. The challenge is that the data is as of September 30th. So ideally, you're looking for more buy and hold type of investors. So that way the data is more of a signal versus noise. That said, there is some interesting sort of golden nuggets, I think, that can be revealed by looking at their portfolio holdings. So let's talk about that now. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. Let's go right into Warren Buffett's Berkshire Hathaway. I previously did a video on how he's holding record cash. If you're interested in learning how to value Berkshire Hathaway, that prior video does go sort of through it, walking through how I think about the valuation. Broadly, I like it. Holding over $300 billion in cash, largely from selling over $100 billion worth of Apple stock this past year. You know, going back to the screen, you're not really seeing a lot of purchases here. Reducing Bank of America, reducing, Apple. You did have some teensy-weensy purchases with Heiko, Domino's, and Pool, of which Domino's was the bigger purchase. I suspect this is from his lieutenants, Todd Combs and Ted Weschler. Overall, less than a percentage of the total portfolio. So what's the sort of thesis for Domino's? You're talking about the number one pizza company in the world. It's really a franchise model. And there's a lot you can learn in 10 seconds or less just by looking at the income statement. So you can see here, wait a second, this isn't really a pizza company. It's really a franchise company where it's benefiting from, yes, it is a pizza company, but it's really benefiting from the franchise model. You can see the biggest revenue line item is supply chain. That's not what you would expect from a pizza company. From a pizza company, you'd expect to see, hey, how many pizzas did you sell? What's the volume of the pizza? What's the price of the pizza? No, this is about the ingredients, the equipment that they're selling to the franchise owners that own the Domino's franchises around the world, both domestically and internationally. You can see that U.S. company-owned store revenue is actually just a small fraction of their total revenue. You can see it's under 10% of their sales. A lot of it comes from that supply chain, a lot from the royalties and fees, i.e. the revenue off the top from the franchise, sales. So they get a, couple percentage straight off the top. So that's pure profit, a great business model. You can also see the international royalties and fees, and they do get these franchise advertising fees, but then they take it and then they spend it straight onto, spreading the words. That way people know about the Domino's pizza. That said, they do have a lot of debt. I think somewhere between 4 and 5 times. That's a little bit more than I'm usually comfortable with. So a sizable interest expense of $120 million plus so far this year. You can also see that they've been using their free cash flow to buy back stock, going, a couple percent each year, reducing the share count. So this is the business model: steady pizza growth, steady opening up of new stores. You get some inflation benefit as well. And then, buy back shares. And so that type of business model, it's very easy, when you understand that there's only really 3 variables that drive a stock over time. It's the fundamentals, it's the change in valuation, and it's the cash flow to shareholders. So when you're saying, okay, the cash flow to shareholders is, let's say, 3-4% a year, and then the underlying growth of the business is maybe 5-6-7% a year. Now you're talking about a 10, maybe low teens type of growth for this business over time. So that's, one way to think about it. I go to AI Ticker Chat to get a quick review of, how would AI think about the potential returns for Domino's in the years ahead. And it's effectively saying, yeah, maybe 100% upside over time, assuming a little bit of a premium multiple, 34 times. That does come from the fact that this is a very stable business and, sort of consistent growth, a lot of free cash flow, a lot of profitability. And so, that sort of upside doesn't really scream out to me as deeply compelling, but I can understand why some, value investors would like it. Looking at Bill Ackman, recently his big new ad was in Brookfield Corporation, BN. I previously did a video on Brookfield and Brookfield Asset Management. He also increased his position in Nike, also did a video on that. I didn't like that Nike has been losing market share to various new startups that are clearly growing much faster. So that does turn me off of Nike. Brookfield is an interesting one. I've owned it in the past. I don't own it now. The main reason why is when the core thesis was with Brookfield is you're like, oh my goodness, this asset manager, it's so great and it has a great dividend. And, clearly management has articulated this fantastic growth that they're going to have in the years ahead and how management thinks they're deeply undervalued. And I get all that, but there is one sort of yellow flag, red flag that just bothers me. And so I it's not something that I want to think about on a daily basis. So I said, you know what, it's just not right for my journey, which is that part of the Brookfield Corporation, they say, look at this huge portfolio of properties, and we're known for real estate investment and how smart we are with it. And we have $15 billion of property that's in our core property book, another $8.4 billion in transitional and development. So that's still, sort of figuring it out. So roughly, let's say $25 billion. The challenge is that the annualized cash flow, let's just look at the core. So not even, transitional suggests it can improve a lot. But at the core business, you're sort of saying this is presumably closer to a stable free cash flow profile. You're saying $500 million in annualized free cash flow versus a $15 billion mark on their property book. So that implies a sub 4% yield, 3 point something percent yield. That's a cap rate for their property. And I just don't quite get why they're marketing it as such, saying, hey, our real estate portfolio, which has a lot of debt on top of it, should be marked at, sub 4% when U.S. Treasury yields are yielding closer to 4.5%. So that sort of that disconnect between where market rates are versus where they're marking their book does make me think it doesn't make me comfortable. And it's not something that, I don't think it's a particularly conservative way of accounting. I think in a conservative way of accounting would be to say, hey, what's the appropriate mark if we were to assume that this is a 6-7% yield type of environment? And there are, businesses that make it very clear, hey, this is a conservative way of doing business. One example is with an insurance company where they say, hey, each year we're going to assume our losses are this. And then each year you end up saying, you know what, the prior year assumptions of our losses didn't turn out to be as bad as we thought. And so it's resulting in a favorable development. And you have years and years of favorable developments. That's an example of conservative underwriting and conservative practices. What I'm seeing with Brookfield isn't exactly conservative. And so it does make me a little uncomfortable. And so that's why it's no longer part of my investment journey. Looking at Stanley Druckenmiller, 30% for 30 years, not a single down year. I mean, this is just, I don't know of any other investor that's as good as he is. And so recently he made this sizable bet in NTRA stock. I'm not even familiar with what they do. This was an 80% change. This is now his top position. So I want to look into that. Now he does trade around things a bit more. Looking at NTRA, so this is Natera. This is a biotech. And so automatically I have a little bit of a gag reflex, like, ugh, biotech. But you quickly realize it's not like a drug development company with, a hit or miss sort of business model. It's about genetic testing and diagnostics. So this means, easily recurring revenue, talking about their Panorama test, which is a non-invasive prenatal test. And they also have tests to understand your various different genetic risks and whether or not you'll pass it on to your kids, or testing for potential tumors, or monitoring for cancer recurrence. So this is interesting because I could easily see this as a recurring revenue type of business versus, hey, we're just going to mark up a drug thousands of % on a very limited audience. So this strikes me as interesting. And keep in mind, Druckenmiller, is a philanthropist, has donated hundreds of millions of dollars to various different, causes, one of which is the Memorial Sloan Kettering, which focuses on oncology cancer. So he knows what's working, what's not working. So he does have this sort of inside edge. I'd say Natera is definitely one worth following up on because you could see this track record grow, the quarterly volumes of their tests going from 200,000 just a few years ago to 776,000. This suggests, you're doing something special here. So frankly, I need to learn more about this business, and seeing Druckenmiller buying it gets my interest. What about Michael Burry? Any sort of new buys from the famous Big Short investor? First, in full disclosure, this is not financial advice. Also, earlier this week, Matthew E., a premium member of the Unrivaled Investing community, shared the following. He said, worth every penny. Netflix, Spotify, and Unrivaled are the only subscriptions I'll never cancel. An incredible value. This also follows Richard M., also commented this week. This is a direct quote. "One of my best investments when I started the subscription." He's talking about Unrivaled investing. By the way, rates for Unrivaled are going up at the end of this month. So now is the time to lock in the favorable pricing for Unrivaled. Looking at Michael Burry's holdings. A lot of people talking about his stake in Alibaba and JD. Looks like he increased it quite a bit, with JD increasing by 100%. This is a sizable part of his portfolio, 21 million, 20 million. Broadly, it's worth understanding that Michael Burry probably has a net worth that's multiples of this. So, he's either sitting on cash, or it's international investments that you're just not seeing. So it is worth understanding that 16% is not in BABA. It's likely a smaller fraction, but it's 16% of his US portfolio that you can see. As SEC requirements doesn't force him to file his international holdings or all of his cash. It's just showing, hey, what do you hold right now in terms of US stocks? But it is interesting that he's hedging his bets. He also bought a sizable amount of puts that sort of offset these positions in JD and BABA, maybe suspecting, hey, I think they're dirt cheap, but there's also a chance that they go to zero because it's a Chinese, situation, and there's inherent risks there. So that is important to reflect on, that he's hedging his bets. Maybe not surprising, given Michael Burry, often calling out the sky is falling type of developments, and I'm sure he's right periodically. I mean, it is important to call that out from time to time. He gets it right. That said, look, I don't want to make fun of Michael Burry. I've done very well aligning myself with some of his stock picks in the past, where I personally think he's one of the greatest analysts out there, because he has a nose for finding deep value stocks. And this is an example where his largest US company is Shift4 Payments. That's actually a stock that I called out to my Unrivaled Investing subscribers a couple of months ago, before Michael Burry even disclosed it. So it came out as a pleasant surprise for me. So in full disclosure, I own Shift4 Payments. You're talking about a payment processing company that's just disrupting the payment space, rapidly outgrowing some of its competitors, has a founder, type of mentality, founder's largest investor. So that it easily meets my personal checklist. I'm going to talk more about it with my community at Unrivaled Investing. We'll probably write about their latest earnings in an upcoming letter. And so, I'll skip Shift4 just because, brief overview just now, but Molina Healthcare, MOH, this is also a situation that he was increasing during the third quarter. So what is Molina Healthcare? So they're focusing on the government-sponsored healthcare programs, in particular focus Medicaid, over 5 million members across 20 different states. So this is health insurance marketplace. So you're talking about health insurance, Medicaid. So generally the low-income brackets, given that it's Medicaid. And looking at the historic free cash flow, you're talking about, a business that's doing around somewhere between, let's say, $1 and $2 billion a year. You can see a few years ago it was over $2 billion. Recently, it's been bouncing around closer to, let's say, $1.5 billion in free cash flow. And looking at the market cap, it's around $15, $16, $17 billion. So you can quickly see why this would get Michael Burry excited, which is that, hey, if you can get a business for $16 billion in terms of market cap and it's generating $2 billion in free cash flow, well, now you're talking about, an 8 times sort of multiple. So that once again, Michael Burry, his deep value nose, sniffing out, these types of situations that are trading at very interesting or compelling, rock bottom valuations. So I find it to be very interesting. Personally, I'm less inclined to go the path of looking at Molina, just because when you have the heavily government controlled or subsidized, or prices are driven by the government, you're sort of at the behest, you're at the control of what can the government finance long term, and what are the policies that they have long term. So I'd rather find things that are more market forces oriented. So overall, I hope this video talking about, what some of the super investors have been up to. You're talking about Michael Burry, Warren Buffett, Bill Ackman, Stanley Druckenmiller. I think there's a lot of interesting ideas here. I think you can balance it out with some of the aggressive ideas, Natera from Stanley Druckenmiller, with the more conservative portfolio orientation with with Warren Buffett sitting on $300 billion in cash. As interest rates move higher, he's in a great position because you can have a dynamic where if interest rates move high enough, everything, all asset prices could reset if that were to happen. And then, by the way, he's getting a nicer yield on his cash. I personally keep my cash at Interactive Brokers. You can see the link below. And so, Warren Buffett would get that nicer yield on that cash, getting a higher income. And then, by the way, you get this reset in asset prices. He can then redeploy it at much lower valuations. So that is one type of scenario. The other scenarios you're finding, the Stanley Druckenmillers of the world, turning over rocks, finding these hyper growth businesses, or you have the Michael Burry saying, hey, what's the stock that's trading at 5, 10, maybe 12 times free cash flow, where it's very obvious it's either stable or going to be growing over time. And a lot of that cash flow can go to you as a shareholder because the math is fairly simple. If you're penciling out something that's very, let's say, flat at 10 times free cash flow, well, if they can just return that free cash flow to you, that's 10% a year before any change in valuation, before any sort of impact and sort of growth. So, hey, if you can find those things at 10 times free cash flow, that might be intriguing. If you can find something at 15 times free cash flow, but it's growing 15%, that's a lot more interesting, at least for me personally on my own investment journey. I'd rather, pay up a little bit, but get that growth. I hope this video has been helpful for you, talking about the super investors and what they're finding interesting. Thanks so much for tuning in to Unrivaled Investing.